All right, welcome back. We're going to do another trade plan. It's part of our exercise where we are going to be planning ahead of time every aspect of a trade, 30 trades, and then execute according to plan. Today's going to be in CMA. In the meantime, I'm going to do a little bit on market structure. I'm going to talk about market structure and put some definitions down because this is what I use for my method. And so market structure, what is market structure? We hear this, it's price action. It's basically putting structure around all these price bars so that you have a way to understand it, right? We're structuring what seems to be chaos. That's market structure. And that way we have a way to orient, we have a way to make distinctions, we have a way to measure. So that's simple market structure. Today we're going to be speaking specifically about swings and swing structures. And I'm just going to lay out a few objective definitions and talk a little bit about it because, swings, and no matter what method you use, whether it's Fibs or Elliott or Wyckoff or median lines, try and hear this with some fresh ears because, you might end up learning something new about, the method you spend a lot of time learning, right? You might begin to see the essence of it. Just try to see it fresh. And so swings are basically the common thread that weave through all markets, all time frames. It doesn't matter. I can go back 200 years and look at markets and find swings, find waves. Actually, everything in the world moves in swings or waves. For our purposes, right, it's the key to understanding who's in control at any given time, right? With all this technical analysis, don't lose sight of the fact that we're just trying to see what buyers and sellers are doing, supply and demand, and who's in control. And so swing structure, right, it's the foundation for all of my frameworks, all of my methods. I use them to map, follow, trade markets, orient myself to markets. If I want to trade consistently, I need to see consistently, and I see in swings, right, without adding my personal baggage to it. So we structure a market the same way we structure our trading. So let's talk about swings. It's pretty simple, right? It has a process. We're going to have an impulse leg. We're going to have a reaction leg, then another impulse leg. And then we can even further take that apart and say at the top of the impulse leg, you'll see price slow down, and we're just going to call that a shelf. You'll see it, right? It slows down, it stalls, and crack. At the bottom of the reaction leg, you'll see a very similar shelf as price has to make its turn. This is what I use in my methods. So let's have some objective definitions. First of all, confirmed swing highs and lows, right? We'll use my little model here. Basically, a new high closing above the high is going to confirm the low and vice versa. And this makes sense, right? It just makes common sense. So for instance, you see a market take off, and for whatever reasons, sellers whacked it, knocked it down here. And then for whatever reasons, buyers picked it up here. So we have two extremes. The fact that it makes a new high is giving us a clue to who's in control and what the intent of this market is, at least right now. So we're going to call a new high our definition for a swing, right? It's going to confirm that swing low, higher highs, higher lows, lower highs, and so on. The next thing we're going to look at here is relative. So according to my definition, there are swings all over the place of different sizes. All I need is a new high to confirm a swing low. And so if we're to measure and think about it, we need to keep things relative. And I'm just going to break it down into major and minor. And I'll put a definition for major. The largest reaction leg in your frame. And you can follow the impulse leg up, right? And then minor, the next largest. So we're just going to do a basic lesson. So we're just looking at reaction leg. If I took this, went to the reaction leg, and see there's no other confirm reaction legs bigger than that. That's my major swing. If I was measuring with my tools, that's what I'm going to measure from. And so this also qualifies as a confirmed swing because it meets the definition, but it's a minor, right? It's smaller. And the reason we're breaking it up is because we want to know what swing we're trading, right? We're trying to be precise in our actions. And if you're using a tool to measure, a fib tool, you want to know what swing you're trading, what impulse leg you're measuring from. You see this impulse leg here isn't quite related to this reaction leg here, right? It's a blue animal and this is an orange animal. They're different. The different buyers and sellers in here. So when we measure, when we trade, we want to know precisely what swing are we measuring, what swing are we trading. Right? We want to measure with purpose. And so I have another definition here, right? Balanced swing. It's just same size reaction legs, meaning that this reaction leg is about the same size as the previous one. It means they're very related to each other. It's like a measured move except on a pullback. Right? So they're related to each other. And we can map a market anywhere. And when we begin to see pullbacks that are about the same size, we're actually spotting tracks for buyers and sellers, right? They're buying it at a certain percentage down or they're selling it at a certain percentage up. So for instance, I can just grab this chart anywhere. And when I look at a chart, when I experience a chart, I see in swings. That's my experience. I see waves. So when I'm looking at this, this is what I see. I don't see all the squiggles and wiggles. Right? I don't have all of that messing me around. I see in swings. And so if I was to map this, see if I can get this going. It's going to look something like this. So this is structuring a market. I'm looking at lower lows and lower highs. And you might even notice that the reaction leg is about the same size, give or take, 10% either side. Right? This isn't random. You might notice that the reaction leg is about the same size. So no matter what I'm drawing, if I'm drawing, I'm drawing very precisely something. And I can come back here and I see in swings. And so I'm seeing things that are relative to each other. Reaction leg. Now, don't mix this up with, where do I trade right now and all that stuff. Before you can trade, you got to at least understand how to see a market, see its flow. So here's what I see in this. I see a market making swing high, tries, cracks, now making lows. It's a very simple way to view things, right? And that's all a line is really trying to tell you. And if I am using my tools, for instance, if I was to use a median line tool, I'm going to draw very specifically from this reaction leg to that one for my measurement. If I'm drawing the impulse, I'm going to draw very specifically from the impulse, top of the reaction, to that one. If I'm drawing from swing to swing here, boom, boom, boom. And I don't care about the jiggles unless I'm trading those particular swings. So this isn't about tools or lines or anything else, right? We're just watching how a market moves. And it's no accident that when you start to see swings about the same size, just normal, hitting it at a percentage. So I see a market that took off and slowly rolled over, now making lower lows and lower highs. Okay, so you can pick up any market you want and measure, right? Just look at the reaction like. So I'm giving you definitions here. It's just going to be a basic lesson on swings. So a swing has a process. So notice, right, as buyers, just think in terms of buyers and sellers. Take it out of technical analysis. As buyers slow down, which they will, you can see it boom, 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 crack, right? Somebody finally makes a decision, and then everybody who's long's got to run. Same thing on the other side. Here, you can watch it here. And you see this outside bar, and then boom, lower low, and then boom, lower low, and then crack, and then the other side. And so I'm just going to call this a shelf. Simple things, impulse, reaction, and two shelves. That's what I use for my methods. And you can look anywhere in a market at previous shelves. Just kind of eyeball the bottom edge of it, and you'll see the interaction that price has with these shelves. So just a little practice, just a little bit of looking rather than trying to find. And so, for instance, this upper shelf where the sellers drop it is often what will cause price to stall here and what many people might call a cup and handle if it meets certain rules. I don't know that much about them, but I call it a pressure cooker because sellers or buyers are meeting sellers on the way up, and I know exactly where they are. Look, crack. And you can see the stall, and then look, crack. Look at the bar, right? It's no accident. These are actual buyers and sellers doing their thing. So again, you might want to just don't think so much about how to use it right now. Just, understand the idea of it. All right, so that was just swing structure. Very simply, an impulse, a shelf, a reaction, a shelf, and then another impulse that makes a new high, closing above the low. All that is a definition. It's not a prediction. At any time, price can not finish that process and keep going. So, right, it's after the fact. It's reading what they did. It's reading and looking where they were. But we need a way to orient ourselves to markets when we get there. Okay, so swing. So enough of that. Let's get rid of all of this and come back to what this lesson is really about. Trade planning and being consistent. So I'm just going to tune in here, and all I'm doing, by the way, is trading a swing. So you notice this one's bigger than these, and it's about the same size. So all I'm doing is just trading that swing, period, and then using an objective way to enter and manage. So I'm just swing trading. I'm trading for this swing to continue. So what I'll do here is I'll put in my fib extension tool, and the only thing I use this for is for my risk reward, objective entry, and stop levels. All right, now we'll put in, and make your trade plan, make a template so you always know what you're going to do. Remember, this exercise isn't about being right or winning. We need to set some psychological foundations and some good habits before, winning comes along in any kind of consistent way. All right, so I'll just use my tool here. And what I'm going to do here is another buy stop to take me into the market. I'm going to get in over here at the 50%. I'm just measuring 50% of this reaction. Like there's nothing special about it. And my stop is going to go at the 25% line right here. And what this will do is tell me exactly where I'm entering and where I'm putting a stop. All right, so I'll begin to fill this out. I know I'm going to enter at 54.44. I know exactly ahead of time where I'm putting my stop, 52.97. And now I need to calculate shares. And what I like to do is use a spreadsheet. It's just part of my routine. So here's our other trades we got cooking. So I'm just going to put the date. Today is, and this is part of the documentation, part of the trade plan. And we're looking at CMA, going long, and we're going long at 54.44. And we're placing a stop, 52.97. It's going to calculate my shares for me. Doing 6-1. So I'm risking, $1.47 in points divided into that gives me my shares. So now I can finish writing this up. This is going to be 340 shares, and I always double check everything in the end. And 63.26 will be my target. All right, so that much is done. So I'm planning for this to take me into the market. So I'm just going to use this to help me with an order here. Just tighten this up. We'll use 54.44. And over here, this is going to be 52.97. And this is going to be a stop, my stop limit order. I don't think it has the option for limit. And we're risking 0.5% of our account. 500 gives us 340 shares. We check everything. Oh, the target is going to be 63.26. And let's just check it out. And we know if we get taken into the trade, we're going to manage at 3-1, which will be up here someplace. We'll start to trail by 2R, and our stop should be placed right in there. All is good. Let's check the shares and send it off. Okay. All right, so that's it. I hope you, maybe got something out of this simple market structure lesson, right? We're just looking and seeing the market in swings, whether they're small swings or big swings, and measuring very precisely whatever tools we use, knowing precisely what swing we're measuring and what swing we're trading. I know that I'm trading this swing right here. Nothing to do with this. Right? For me, it's not related. All right, so we'll follow up on this in the updates and then see you next time.